One share 75 lakh rupees and broken trust. Late at night, a son was staring at his phone screen, and his hands were probably shaking as much as his father's confidence. There was once 75 lakh rupees in the account, now only around 30 lakh rupees remained. This was no lottery loss, no gambling app, no fraud call. This money was a father's lifetime of savings, which slowly got locked into a single stock. The son wrote on social media that his father had started investing back in 2013. On a relative's advice, he bought shares of a company and then kept putting every bit of savings into it. The question wasn't how the stock fell. The real question was how an entire family failed to realize that their financial life was riding on just one company. Things probably started off very normally at home. The father must have thought that his hard-earned savings from his salary would now grow in the market. He must have felt he was securing his family's future. The first investment was probably small, a little confidence grew, and then a bit more money was put in. When someone tells us that a stock is a long-distance racehorse, hope quickly turns into trust. But in the stock market, the most dangerous mistake often starts not from greed, but from trust. A person thinks they are being smart while risk quietly slips inside the house. According to the Post, nearly 30 lakh rupees from the mother's Demat account, 20 lakh rupees from the uncle's account, and around 25 lakh rupees from the father's account were invested in that same stock. From the outside, there were 3 accounts. But on the inside, all the money was in the exact same place. This is the precise twist where many investors mistake themselves as diversified, when in reality, the risk stays identical. Having separate Demat accounts is not diversification. Diversification happens when money is spread across different companies, sectors, and asset classes, so that a single mistake doesn't end the entire story. The family probably felt that because the investment was growing bigger, the future was becoming stronger. But sometimes a portfolio isn't growing bigger, it's growing fragile. The difference isn't obvious right away. When a stock goes up, an investor feels like a genius. When that same stock comes down, they realize that their confidence wasn't built on knowledge, but on price movement. Every new bit of savings kept going into that same stock. A bonus came in, some money was saved, a fixed deposit matured, and that same old decision was repeated all over again. Slowly, this stopped being an investment strategy and became a family habit. And in the financial world, a bad habit can prove far more expensive than a bad stock. This brings up the biggest question. If the father didn't have much understanding of the market, why did he invest such a large sum of money? The answer is as simple as it is terrifying. Because in middle-class households, financial decisions are often driven not by research but by relationships. A relative, a friend, an office colleague, and a single confident line. This share is going to skyrocket. That line doesn't come with a chart, a balance sheet, or a debt analysis. But it comes with trust. And many times, trust turns out to be the most expensive shortcut. Nobody probably asked what the company actually does, whether profits are growing, how much debt it carries, what the promoters are doing, whether the industry has a real future or just a good story. In the stock market, listening to a story is easy. Reading numbers is hard. And when an investor falls in love with the story, even the warning signs in the numbers start sounding like noise. Then comes a time when the stock begins to fall. First, the investor says, it's just a correction. Then they say, let's average it out. Then they say, since it has fallen this much, it has to go back up. This is the most dangerous moment. Because now, the investor isn't defending the company. They're defending their own past decision. They aren't doing analysis, they're trying to prove themselves right. When a loss is small, it's easy to accept. But when a loss turns into lakhs, ego, guilt, and hope, all combine to grip a person tight. From 75 lakh rupees down to 30 lakh rupees. This isn't just a drop of 45 lakh rupees. It's a burden placed on retirement planning, children's dreams, household security, and a father's self-respect. The son wrote that his father considers himself responsible and feels defeated. This line hurts the most, because the pain of an emotional loss is often far greater than a financial loss. A father who earned for his family his whole life now sees himself as the cause of the family's loss. Here, the silence at home becomes far heavier than the market chart. The post went viral on social media and a flood of advice followed. Some said accept the loss and move the remaining 30 lakh rupees into a diversified portfolio. Their logic was straightforward. Saving 30 lakh rupees is still a big deal. If the risk stays the same and the stock drops further, the loss won't just increase in the account, it will grow in life too. Others suggested something else. If the company is fundamentally sound and the business can improve, exiting in a hurry might also be a mistake. This is the exact dilemma that breaks an investor. Holding brings fear. Selling brings regret. Waiting brings uncertainty. And every path opens up a brand new question. That's when a user asked a practical question. If you had 30 lakh rupees in cash today, would you invest it in this exact stock? The question is simple, but sharp as a knife. If the answer is no, then why stay trapped in that stock just because of past losses? This is the major trap of investing psychology. Our mind gets anchored to the purchase price. We feel that justice will only be served when the stock gets back to our buying price. But the market couldn't care less about our buying price, our emotions, or our family situation. The market only cares about business, earnings, demand, sentiment, and future expectations. This is where the real lesson of the story begins. The mistake wasn't just buying one stock. The mistake was building conviction without understanding the risk. Conviction comes from facts. Attachment comes from past decisions. When facts are few and hope is high, an investment slowly turns into a prayer. Diversification doesn't guarantee profit. What it means is that a single wrong decision won't hold your entire financial life hostage. If the portfolio had contained different sectors, mutual funds, debt, an emergency fund and some direct equity, a loss could still have happened. But the family's sleep probably wouldn't have been broken like this. Many say that big money is made through concentrated bets. That's a half-truth. Yes, some investors built wealth through concentration, but they understood the business deeply. A concentrated bet by a billionaire investor and the life savings of a middle-class family are not the same thing. One has a cushion, for the other their entire security is hidden inside that very money. This is why position sizing is the most underrated rule. Before asking which stock to buy, you should ask how much of it to buy. Even a great company can be dangerous with the wrong allocation. Just like a strong pillar cannot be the sole support for an entire house. There is another hidden truth in this incident: the lack of transparency in family finance. If there had been a yearly portfolio review at home, the risk probably wouldn't have grown so silently. Every family should know where their money is invested, for what goal it's set aside, how risky it is, and how it can be pulled out if needed. Opening a stock market app is easy. Pressing the buy button is even easier. But reviewing, rebalancing, and having exit discipline is where a real investor is made. Today, social media has made investing highly accessible. But access and understanding are not the same thing. Opening a Demat account isn't financial education. Profit screenshots go viral quickly on Reels. Loss stories often get buried in shame. That's why new investors end up thinking that making money in the market is effortless. But wealth creation is a boring process. Regular investing, emergency funds, insurance, asset allocation, tax planning, and patience. There's less drama in it, but a lot more survival. This father's story stands out because there is no villain in it. No fake app, no scammer, no hacking. Just trust, ignorance, and concentration combining to inflict damage. A lot of financial disasters happen just like this. They don't fall apart suddenly. They build up slowly, with every month's savings, with every repeated decision. Now the real question facing the family is, what comes next? No one-line answer from a comment section can be right here because the decision depends on the family's specific needs. Without understanding the company's current condition, future prospects, valuation, tax impact, liquidity needs, and risk capacity, both exiting and holding could be incomplete decisions. In a situation like this, a SEBI-registered advisor or a qualified financial planner can offer practical help. Because here, it's not just about a stock, the entire family financial roadmap needs to be rebuilt. First, the emotional emergency needs to be handled. The father needs to be brought out of the blame cycle. Because a decision made out of guilt can be just as dangerous as one made out of greed. Next, the financial emergency must be looked at. 30 lakh rupees is still a lot of money. It can be protected, restructured, and deployed according to the right goals. Recovery doesn't mean quickly turning it back into 75 lakh rupees. The primary meaning of recovery is that a single mistake no longer controls your entire wealth. Even if the company is fine, there's no compulsion to keep all the money locked in it. An investor can hold on to hope, but family security cannot be left to hope. If the company is weak, it'll go up someday cannot be a strategy. Time is a friend to a good business, not a doctor for a bad investment. A powerful exercise can help here. If you had fresh cash today, how much would the family put into equity, debt, an emergency fund, and direct stocks? Then compare the current portfolio with that answer. If there's a huge gap between the two, understand that the portfolio isn't running on present wisdom, but on past emotions. Sometimes a phased exit or a phased rebalance works better. Instead of making a sudden move, taking step-by-step action while keeping tax, price movement and family needs in mind can be more practical. But most importantly, the decision shouldn't happen in silence anymore. The family should sit together, look at the numbers, write down goals, and define the exact purpose of every rupee. Because money isn't just money. Some money is for emergencies. Some is for children's education. Some is for the dignity of retirement. And only a small portion should ever be a high-risk experiment. The sooner this is understood, the smaller the loss remains. The longer it takes, the more personal the risk becomes. This viral post shook thousands of people because the exact same possibility is hidden in almost every household. For someone it's a risky stock, for someone else it's land, a policy or crypto. Concentration doesn't happen only in the stock market. When all hope rests on a single asset, a single business, a single person, or a single piece of advice, risk quietly multiplies. Investing requires a process, not love. There can be trust and patience, but there shouldn't be blind attachment. The son said perhaps the most mature thing when he mentioned he didn't want a lecture, he wanted to make a sensible decision. That shift is the very first step from loss toward learning. The father's mistake shouldn't become his identity. The mistake was a system failure. And a system can be changed if the family drops the blame and embraces the process. The single biggest insight from this story goes way beyond diversification. Before putting money in, it's essential to understand what that money is meant to do and who will bear the risk. Because in the market, every stock brings more than just a chance of returns. It impacts your home's peace, planning and future. This story of 75 lakh rupees turning into 30 lakh rupees isn't just one family's tragedy. It's a mirror for every investor, raising a crystal clear question. If your life savings are standing on a single hope today, is that an investment or a silent gamble?
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.